oil crashed hard and is likely not done yet. And I am loving it. I am buying oil stocks in weakness. Shock, horror, yes. Oil stocks, one of the best investment opportunities long-term in the market right now. And in today's video, you will find out why. I'm going to show you a chart of the NASDAQ. If you invest in high tech, you need to see this chart. I'm going to give you the 3 reasons why oil stocks are such an interesting investment opportunity right now. And I want to give you one graphic, only one, that you need to see that tells you everything about the oil price and therefore the oil stocks. Let's get into it. Welcome to Hot Trades of the Day, your show for swing trading ideas for the coming days, weeks, and month. Okay, let's start with the charts. My name Daniel Wilhelmi. Welcome to the channel. We're jumping right into it. You saw a nasty sell-off. Yeah, we can even call it a mini crash of oil after we doinked off the downtrend that started in April, just as we did here, after the most recent peace talks that are already history again. So this mini crash, very reminiscent of this doink right here, and then this crash, right, with a gap down, and then afterwards we have one more final sell-off here, doinked off this downtrend, which is broken already. This is important. We're going to talk about this in a minute. Here, doinked off it, gap down, one more final sell-off, even flushing below the 200-day moving average, the golden line that you see right here. This purple line is the 50-day moving average. So right now, when I called out the change in oil about here and said, hey, things are changing in the oil markets, I said, the 50-day is not that important. Would be nice if we hold it, but not that important. What is really important is the 200-day. If we stay above the 200-day, the golden line, then you can see once we really broke below it, which was basically here, and then confirmed with a new low, we stayed below it except 2 nasty bull traps. And that's what oil always has going here. This could turn out to be a really tough bear trap. And that is the reason why, as I told you in my most recent oil video, I'm not investing in oil because you cannot calculate the risk to the upside when there are new military attacks coming from Iran, from the US, both sides, or the most recent with US and Saudi in Iraq, or on the downside when all of a sudden the Trump government comes out and says, well, peace talks are happening. By the way, never the Iranians that come out with the peace talks. Something to keep in mind. So I think we have weaker oil prices to come. But as we know, it's really impossible to say that with certainty simply because of the geopolitical aspect. Now, we look at this right here, and we do have, let me draw it in like this. We do have a small kind of support zone. Okay, that's fine. That held. But this is not really structure. This is structure, right? Where we tested the lows numerous days, kind of bounced around it. You could see, oh, the selling pressure is declining. RSI is improving. And then we got a big up move. And then obviously when we broke the downtrend and the 200, that was the sign to get on board. And we did the video here on the channel. So I don't expect this to be the end, but this is really all driven by geopolitics, which again, I cannot influence. Man, that would be great if I could influence that. So therefore, I'm staying away from any speculation in oil. Instead, I'm focusing on the oil and the energy stocks, which are the much better investment. I will show you a chart that will blow your mind in a few minutes where I compare the oil price to the XLE, the energy stock ETF, and be prepared for this shocker. So now let's talk about what are the 3 reasons why I buy oil stocks. I mean, oil is super volatile. It has declined a lot. The oil stocks have in parts declined, parts not so much. That's interesting. With some of the stocks that I presented on this channel, Exxon, Chevron, Shell, Equinor, Petrobras, Ecopetrol, you made bank this year. So you know how much money can be made in the energy stocks on top of all the juicy dividends you get, which, by the way, bonus reason why I love the oil stocks so much. I get a juicy dividend. But it all starts with the oil price for the oil companies. So if you watched my channel or you watched the show Landman, very entertaining show, by the way, you know that we don't need oil prices over $100 a barrel for the oil companies to be highly profitable, printing money. Oil prices of $85 is really around that range. So let's say 80 to 90. That is the sweet spot for the oil companies to be extremely profitable. And while we are pretty much at the lower end of this range right now, prices of 85 to 90 are absolutely justified. And the reason is the geopolitical uncertainty. The fundamentals. This is the interesting part that a lot of people get wrong. They look at the US economy, they look at the Chinese economy, they see the weakening economies and they say, well, the oil demand is going down. Yes, that is true, but the demand is only one side of the equation. That's what happens when you have people talking about commodities that really are not with deeper knowledge about the commodity sector. It is supply and demand. The demand can go down, but guess what? If the supply goes down faster than the demand, then you still have a scissor between supply and demand, and the price is still going to be high or even go up. In case of oil, we have a supply problem. And we're going to talk about this in correlation with a graphic that I'm going to show you that will blow your mind in a minute. The oil from the Middle East, and this is especially true for Europe, and this is going to be a problem. I'm not only talking about the Strait of Hormuz, I'm also talking about the pipelines that the United Emirates or Saudi Arabia or Qatar or all the Middle Eastern countries are trying to build now with the highest possible speed. Well, we just saw the attacks in Iraq of US and Saudi forces together attacking rebel groups there that were apparently or allegedly told by Iran to attack oil pipelines and oil infrastructure in Saudi Arabia. As long as Iran has proxies like the Houthi rebels or Hezbollah that they can use to reach the pipeline structures, the pipelines are a nice thing to put on a postcard, but there has to be a risk premium built into the oil price. And I believe this is happening now. This is why it's interesting to see what the oil price will do. Do we stay above the 200-day, the golden line that you see here in the chart? If that is the case, then we see a trend in the oil price, and we will probably stabilize around $80 to $90 a barrel with significant upside, unfortunately, which is not great for anybody. Because of the risk factor in the Middle East. And you can say, well, yeah, the US is the largest exporter of oil in the world now. Yes. Well, wait for that to answer that question in a second. So I have the fundamentals in my bag if I'm an oil stock investor. And the big fundamental here on the demand side is that the Iran war, threw in a German word there, doesn't surprise that had to do something with war, that the Iran war will more and more countries clearly show we need to build up strategic reserves. So not only does the US, whose reserves are quite low, have to refill its strategic reserves. There will be more and more countries who say we need to build our own strategic reserves because we cannot be sure that the US will provide us with enough oil or that we can get enough oil at decent prices, because you can always get the commodity. It's just a question of the price. Or increase these oil reserves. There is a new demand side that is coming to the market in the coming years that a lot of people are not accounting for. They're only looking at the US and they say, which rightfully so, hey, the strategic reserves of the US are depleted, yes, and they need to be refilled, but they don't need to be refilled 100%, which is totally accurate, right? We have to remember that the strategic reserves and the amount comes from the 1970s when the US was a net importer of oil and highly dependent on Middle Eastern oil. Now, 2026, completely different picture. Largest oil exporter, one of the largest oil producers. It does not need the reserves that it needed in the 70s and 80s. Today, that is true, but again, this will be more than overcompensated by other countries stepping into the business of strategic reserves for the first time. So while the economic demand, yes, that might slow down, the geopolitical demand, let's put it like this, will be very high in the coming years. The second reason, and this is where we flip to the NASDAQ, and boy, if you invested in the NASDAQ, and I would assume a lot of you are through ETFs or any other type of passive investing, you're not going to like what I'm going to show you. So this is the QQQ. This is the chart of the most popular ETF for the NASDAQ. And if you watched my last video on SpaceX and the NASDAQ, you're familiar with this chart because I showed it to you 2 weeks ago. And I showed you that diamond formation, and I told you, ooh, if we broke below this diamond formation, that is a sell signal. If we break below this very important support zone, this blue zone that you see right here, we are going down at least to the 200-day moving average, the golden line, but really lower. If you missed this video, hit the subscribe button so that doesn't happen to you again. You could have been way ahead of the market. I even kept the arrow that I drew in, where I said, okay, I think with earnings season coming up, I think we're going to retest the 50-day, and then if we break lower, we're selling off. We didn't even retest the 50. This is how weak the market is. We only tested the lower end, basically the breakdown of the diamond formation, and we're already selling off hard. And we got gaps open galore. We got this gap open, we got this gap open, we got this gap open, and we got a gap open down here. So if you believe in gap fills, it's going to be a way down in the tech stocks. And we're already seeing that. We're already seeing this in parts of the tech sector. It's really Apple holding up the whole market right now. And the reason being is because Apple didn't participate in the AI infrastructure build out and the massive amount of money. That's really the reason. We see the hardware and the memory sector just getting absolutely killed in the market. South Korean market absolutely getting slaughtered. So if now the Mag 7 or the hyperscalers, as they are called as well, if they don't hold up, we saw it after Google and their sell-off in earnings season, it'll be a real problem for the tech market. But the money cannot leave the equity markets altogether. So what does it do? It rotates. This is reason number 2 after the bullish fundamentals. Actually, reason number 3, right? We got the oil price should be at 85, which is great for the oil companies. We got the geopolitical fundamentals that are pro-oil as well long term. And now we got the rotation in the equity market. Sorry, can't be smart and good looking at the same time. You guys got to pick one. So it's going to rotate, and we're already seeing this. We are seeing a rotation in defensive tech and defensive sectors like healthcare, some big financials, old economy, like Coca-Cola, for example. It's already happening. And the energy sector is a sector, yes, cyclical, correlated to the volatile oil price, but it's cheap. And at some point, money will rotate into the energy sector, and it doesn't have to be a lot because energy sector is really, really small after being neglected for years for the tech companies to make a move and to create an up move in the energy stocks. If institutions look around and say, where can I put my money to work? And they see oil prices stabilizing between $80 to $90 a barrel, and they see these cheap oil stocks, and they see the chart that I'm going to show to you in a minute. Yes, the rotation is a real possibility, and that is beautiful for me if I'm invested in oil stocks. Now, let me show you the graphic that I talked about, right? And this is the type of thing that the institution is going to pay attention to. I can show you 20 graphs about oil supply and demand. You really only need to see this one. And let me move my ugly face out of the way. This is from Bank of America. And this shows you the U.S. crude inventory since 1982. And look where we were in June of 2026, and things hasn't gone better in the past weeks. All-time super lows. You see the dotted line, the average 65 days? Yeah, that's probably where we should be. But even if we would be at the low end, pretty much in the middle of the chart that you see, that lower level around 98 to 2002, which, by the way, was the new economy boom. Even if we get just there, which will still be historically very low levels, as you can see, that is a big up move, a big demand up move that has to come at some point. Now, I told you I'm not investing in oil itself because I cannot. Here we go, and there it is. Because I cannot calculate the risk. I like the oil stocks. Now I want to show you a chart now where I compare the oil price to the XLE. And this one will show you all you need to know. And we're going to go back on the daily to 2025. Here we go. And I'm going to just turn off the 50 and 200 just to make it a little not as convoluted. And now I'm going to overlay the XLE. And here you have it in, you know what? let's make this. Can I not change the color? All right, doesn't matter. Let's keep this blue. And as you can see, the oil stocks almost always outperform the oil price. Remember this if you followed this channel. Here, fall 2025, when I was saying on this channel, hey, something is up, the oil price is going down, but actually the oil stocks are going up. And that's when I was here telling you, hey, I'm not your financial advisor, but you may really want to look at energy stocks. Yeah, remember that time? Man, we had a good time afterwards in the first quarter of 2026. But here's the interesting part. Since the beginning of 2025, oil is up about 18%. But the XLE, the oil stocks, are up almost 37%, almost twice as much as the oil price. Yes, when oil goes crazy, as you can see here, it outperforms the oil stocks. But overall, you make a lot more money with the oil stocks than with oil. And the reason is what you see here. Look what has happened since the beginning of the war, or let's say the first week of the war. But you can really say the beginning of the war, doesn't matter. The oil stocks have basically gone sideways, while oil, after the initial crazy surge, has gone down dramatically. So the pullbacks in the oil stocks are much lower. My volatility is much lower than it is in oil. And yes, when there's something crazy happening geopolitically, oil will go up harder and faster than the oil stocks. But because the corrections are not so steep in the oil stocks, in the end, I'm going to make more money than I do in oil as a more long-term swing trader or investor. And I don't have the volatility. And I don't have the geopolitical risk like I would if I was directly invested in oil. So that is the reason why I am buying oil stocks. If you like today's video, hit the subscribe button. I wish you a really, really good day. Tomorrow, we got a really interesting video about gold royalty companies. If you watched the Rick Rule video, you know this is one of his favorite investments in the mining sector. Tomorrow, you'll learn why. See you tomorrow. Have a great day. Bye-bye.